All right, today we're diving into a fascinating situation, a real pressure cooker building up around a company called Rezolve AI. We've got two sides locked in a battle so intense that the market itself is bracing for an absolutely massive explosion.
And that brings us to the core question of this whole story. How on earth can the professional options market look at a stock and predict with data a potential move of over 60% in just a matter of weeks? It sounds crazy, but let's unpack how they're getting to that number.
And there it is. For the period ending in late January, the market has priced in an expected move for RZLV of plus or minus 61.5%. Now look, that is not a small move. That's a massive, portfolio-changing swing, and it's a huge signal that the smart money is preparing for a truly violent resolution. So what in the world is causing all this tension?
Well, it all starts with a company that is, quite literally, under siege. You've got Rezolve AI's management team fighting for their company's life on one side, and on the other, you have a group of very determined short sellers who are betting everything on the company's total failure.
So let's break down the two opposing arguments. The short sellers, led by a firm called Fuzzy Panda, have what they call a zero thesis. Basically, they're saying Rezolve's contracts are fluff, not real, scalable revenue. They're pointing to the company's history of burning cash and saying bankruptcy is right around the corner. But Rezolve isn't just ignoring this. They're preparing what the source material calls unassailable financial confirmations to prove, with hard numbers, that their business is not only real, but also profitable. And their counterattack is a two-punch combo. First, they're planning to officially validate $200 million in annual recurring revenue, or ARR. That's the steady, predictable income you get from subscriptions, the holy grail for a company like this. It's a direct shot at the idea their sales aren't real. Second, they're aiming to prove they've hit positive adjusted EBITDA. Just think of that as a way of showing their core business is actually making money, not burning it. This one is aimed squarely at the bankruptcy argument.
And here's the absolute kicker. If, and it's a big if, but if Rezolve can actually confirm both of these numbers, the short thesis doesn't just get a little weaker, it completely and mechanically collapses. The two pillars holding up the entire bearish argument that the revenue is fake and bankruptcy is coming are just vaporized by the data. And that, my friends, is pure rocket fuel for a potential short squeeze.
Now, this battle isn't just about what happens, it's all about when. The source material lays out a very specific timeline, a countdown to a series of events that are creating this incredible pressure cooker of a situation.
And this calendar is the key to the whole thing. It all kicks off on December 31st with what's being called the floor. That's when they're expected to confirm they're no longer burning cash, which basically takes the bankruptcy risk right off the table. Then, boom, January 1st, we get the rocket fuel, a big commercial launch with a major partner designed to prove the tech is legit. And it all leads up to the grand finale between January 13th and 15th, the verdict, which is the official earnings announcement.
And that final announcement is set up to be a devastating one-two punch for the shorts. The company is expected to not only confirm they hit their $200 million ARR target, validating their past success, but to also set incredibly high expectations for the future, talking about their path to $500 million. It's a move designed to leave any remaining short sellers with absolutely no choice but to give up and cover.
Okay, so we've got the story, we've got the timeline. But let's step away from the narrative for a second and look at what the cold, hard, impartial numbers of the options market are telling us about all this.
To really get this, we need to understand a term called implied volatility, or IV. Honestly, the best way to think about it is like this. It's the price of an insurance policy. If you think there's a high chance of a hurricane, the cost of hurricane insurance goes way up, right? Same thing here. When the market thinks a huge price swing is coming, the cost of that insurance, the IV, goes through the roof.
And when IV gets as high as it is for RZLV, it signals something even deeper. It's not just risk, it's what the source calls market dread. It means professional traders are genuinely terrified of what might happen. They're preparing for absolute chaos, hedging their bets like crazy because they know the situation is about to get violent. Which brings us right back to this incredible number. That plus or minus 61.5% isn't a guess. It's calculated directly from that sky-high implied volatility. It's the market's mathematical way of screaming, we have no idea which direction this is going, but we are absolutely certain it's going to be a gigantic move. And what's so crucial here is that this volatility spike isn't random. It is timed perfectly. The market is pricing this enormous move to happen right around that mid-January earnings window. It's bracing for the final, violent showdown between the shorts and the company that we just laid out.
So, let's get down to the mechanics.
If the news is good, how does all this tension actually release? And, just as important, what's the big risk you have to watch out for? This brings us to the final act, the squeeze and the trap.
Okay, so a short squeeze is a beautiful, chaotic process that unfolds in 4 basic steps. 1. The good news hits, and the short thesis is instantly proven wrong. 2. The short sellers are now forced to buy stock, any stock they can find, to close out their losing bets. 3. They have to do all this buying in a market where very few people are actually selling. And 4. That massive imbalance, huge demand crashing into tiny supply, is what sends the stock price into the stratosphere.
But, and this is a really big but, there is a massive threat looming just over the horizon, right after that potential squeeze. It's called a lockup expiration. It's basically a rule that stops insiders, the founders and early investors, from selling their shares for a while. But when that lockup ends, a potential flood of new shares can be unleashed onto the market all at once.
And this sets up 2 forces that are the polar opposite of each other. The squeeze is driven by a scarcity of shares, right? Where forced buyers can't find enough stock. The trap is the exact reverse, a potential flood of new shares from insiders who are now finally free to sell. And that flood of supply can instantly overwhelm demand and send the price crashing back down. This is exactly why the strategy laid out in the source material is so incredibly time-sensitive. The whole play is based on a very precise window. It opens with the good news catalysts in early January, and it slams shut right before that lockup expires around January 23rd. The idea is to ride the squeeze up and get out before that potential wave of insider selling can hit the market.
So this is where we're left. You've got a clear conflict, you've got a specific timeline, and you have a market pricing in a massive 61% move. All the signs are pointing to an absolutely explosive outcome. The only question left is, which way is it going to break?